Hello, welcome back to Principles of Corporate Finance video lecture series. Today on session 7, we'll talk about stock valuation. At the beginning, said that companies may raise funds through two sources, through bond financing and equity financing. So, on last session, we talked about bond financing and bond valuation. Today, we'll continue on stock valuation. Stocks are company shares that are traded on financial markets. So as an investor, if you go and buy a stock, you expect to get dividends and holding for some period your stocks. At the end of that period, you will sell off your stock and get some capital gain. General principle of any financial asset valuation is the price of that asset is present value of future expected cash flows. This logic also applies in stock valuation. So, price of a stock is present value of future cash flows to the buyer. As I said, you expect to get dividends, that's cash inflow, plus at the end of period you will sell off, get some capital gain. So, price of that stock is present value of these dividends and that capital gain. So we need to then determine these dividends and that capital gain. So these dividends may grow in three scenarios. One is dividend is constant. So assume that dividends will remain at the same level forever. That is expected dividend in first period, D1. It equals to dividend in second period and goes forever. From our time value of money, we know that this is a perpetuity. If we have constant payments that go forever, this is perpetuity. And finding present value of this perpetuity is very simple. That's cash flow, we said, divided by required rate on these cash flows. So cash flows in this dividend series is dividends. Dividend 1, dividend 2, dividend 3. So present value of this perpetuity is dividend divided by rate. We have an example. Suppose big deal company will pay an annual dividend of $2 per common share that will never increase or decrease. It means that it will remain fixed, constant. The market rate of return is 8.5%. What's the maximum amount you should be willing to pay for a common share of big deal corporation? The maximum amount you will pay is the price. People are rational, no one will pay higher than its price. Price is dividend divided by rate, $2 divided by 0.085, this is $23.53. So the maximum you will pay is $23.53, this is the price. Second scenario of dividend dynamics is not constant, but it grows at constant rate. That's next period's dividend equals the recent dividend times 1 plus G. It grows at G rate forever. Then dividend 2 is previous period's dividend times 1 plus G. And dividend 3 is previous period's dividend times 1 plus G, and it goes forever. We understand that this stream of cash flows looks like growing perpetuity. So present value of growing perpetuity is dividend cash flow divided by R minus G. This R is required rate and G is dividend's growth rate. Again, we have an example. Suppose big deal again just paid a dividend of $0.5. It's expected to increase its dividend by 2% per year. That's it increase forever. If the market requires a return of 15% on assets of this risk level, how much should this stock be selling for? So if the risk level is the same, we can apply this market rate, this required rate to our company's required rate. We can take them the same. You see that this increases, this growing perpetuity, and present value of these cash flows is, as in our formula, dividend 1 divided by R minus J. This is just paid dividend, that is dividend on time 0. But in our valuation, we take next period, that's expected dividend. So this is just paid dividend. So we increase this by 1 growth level, that's 0.5 times 1 plus growth rate. This is dividend 1, divided by R, this is required rate, minus growth rate. This is 3.92. Again, here we see in our formula, this is dividend 1, next period divided by R minus G. It's important to understand that the constant growth model calculations are based on, as I said, on next dividend. If a situation only provides information on the last dividend, just paid dividend, it must be increased by the growth rate to arrive at the next dividend. So it's important to pay attention to expressions just paid or next periods. If it is just paid dividend, we need to adjust it to next paid dividend. If a situation provides the value of the next dividend, then the data necessary for the calculation is known and need not to be derived. We have D1, we just divide it by R minus J. An analyst must discriminate whether they have information about the next or last dividend and proceed with calculations accordingly. It's important, as I said, to pay attention if it is just paid dividend last year's or it's next year's dividend. Next scenario is differential growth. Big reminder, first one is dividends are constant. Second one is dividends grow at constant rate. Now they have differential growth rate. It means that for some period, difference may grow at some constant rate. Afterward, growth rate may change, or for some period, dividends may grow at some rate, then will go forever at some rate. So it changed due to condition of economy, conditions of that company, and other factors may affect this growth. Assume that dividends will grow at different rates in the foreseeable future and then will grow at a constant rate thereafter. To value a differential growth stock, we need to estimate future dividends in the foreseeable future, estimate the future stock price when the stock becomes a constant growth stock. It goes back to our second scenario. Compute the total present value of the estimated future dividends and the future stock price at the appropriate discount rate. So, however the dividends grow, the principle is the same. We need to find dividends and find its present value. So first we need to determine how in this growth rate, in this growth model, how dividends will be in future, and then we need to find its present value. Assume that dividends will grow at rate G1 for n years and grow at G2 thereafter. We have a stock that its dividends grows at G1 for first 3 years. Let's say this is 4%. So starting from fourth year, it grows at 2% forever, for example. What's the price of this stock? Same logic, we need to find dividends here. So growth rate is here, G1, G2 and G3. G1, G3 they are same. Starting from this period, it is 2%, 2%, and 2% forever. So these periods are 4%, 4%, 4%, and this period is 2%, 2% goes forever. All we need to is to find dividends after this grows and find its present value. So for first 3 years, we see that it's a growing annuity formula, and this part, only this part, growing annuity formula, and that is our growing annuity formula for 3 years, first 3 years. And this is P 1, 2, 3. 1, 2 through first 3 years. And we have this part also. And here we see that it's growing perpetuity. Present value of growing perpetuity, we can put it that way. P from 4 to n. That is growing perpetuity. Present value of growing perpetuity is dividend. Here is cash flow. And this is D4 divided by R minus G. Here we see our D4 is D0 times 1 plus G1 times and 1 plus G2 here. That is G2. That is 1 plus 4%, 1 plus 2% divided by R minus G. What we find here is present value of dividends growing at 2% from nth period. So we found its present value. It comes to third year because present value discounts back one period back. So this becomes present value of these dividends starting from fourth year forever into third year. And we calculate all these cash flows, consolidate them and get, that's our dividends, present value of perpetuity. We discount it back to year one, and this part is present value of growing annuity until from first year to third year. We have an example here. A common stock just paid a dividend of $2. The dividends is expected to grow at 8% for 3 years, then it will grow at 4% in perpetuity. What's the stock worth? The discount rate is 12%. So just paid means this is D0, and for 3 years, then it will grow at 4% in perpetuity. Best way is draw a timeline. It just paid $2 and it grows 8%, and for first 3 years 8%, 8%, 8%. And starting from third year it grows at 4%. It's perpetuity. 4%, 4% and others. If the discount rate is 12%, what's the present value of these cash flows? We see here first 3 years, this is growing annuity. We can find present value of these growing annuities. Present value from 1 to 3 is dividend 1, D1, that equals to $2 times 1.08, $2 times 1.08, divide by R minus G, that's 0.12 minus, I'm just applying formula, times 1 minus 1.08 power of 3, 1.12 power of 3. This is present value for first 3 years. Dividend grows, that's first dividend 1 will be $2 times 1.08, dividend 2 will be this amount, $2, 1.08 squared, dividend 3 will be 2 times 108 power of 3, and dividend 4 will be 2 times 108 power of 3 times 1.04. So it goes for it. So present value of this growing perpetuity, we know present value is dividend 1 divided by r minus g. Here present value 4 to infinity equals to dividend 1, that's 2 times 108 power of 3 times 1.04 divide by r minus g. This is 0.12 minus 0.4, that's 4%. So what we find here, this is present value of this amount growing at 4% forever. We find present value here in third year, it comes to here, it becomes P3. So since we are on time 0, we need to discount it back to time 0. So price 0 then becomes present value of this amount, this is present value already, times plus present value of this amount. That's 2 times 108 plus present value of this amount. This is on time 0, we discount it back at 12% for 3 periods. So what we get here is present value of all expected dividends. That is price of this stock, $28.89. So again, this part is growing at of first 3 years, and this is present value of growing perpetuity starting from 4th period to infinity. Sum up all these numbers, we get $28.89. So this is with dividends with differential growth rate. For first 3 years, it grows at 8%. Starting from 4th year, it grows at 4%. So in our calculations, these parameters are important. Where does G come from? G is calculated as retention ratio times return on equity. Retention ratio is retained earnings divided by net income. That's what part of net income is retained in company. One example, suppose a company has a retention ratio of 70%, that company pays out only 30% of net income, and the earns and return on earnings of 12%. What's the growth rate? In this situation, in this case, how much can we expect dividends will grow? That is very simply retention ratio times return on earnings, that's 8.4%. If this condition continues, our dividends, company's dividends, will grow at 8.4%. And these are required rate. That's the discount rate can be broken in 2 parts, dividend yield and the growth rate in dividends. Also, it's known as capital gains yield. R reflects all associated risks with that company. So it reflects all possible risks, that how much, based on this risk, how much investors required from this company. In practice, there is a great deal of estimation error involved in selecting R, For example, cases stocks not paying dividends. Stocks with G expected to equal or exceed R. So in our formula, that's R minus G. If it equals or higher than R, mathematically it will be okay, but financially it's a problem. Stock price cannot be minus. We can apply our dividend growth model. So far we talked about dividend growth model. All our cases, three scenarios are associated with dividend growth model. Applying our dividend growth model, that was in our constant growth model, P price equals to dividend 1 divided by R minus G. If we take this R here, that's D1 divided by P0 plus G. We know this part is dividend yield. D1 divided by P0 is dividend yield, and G is the capital gains yield. We have an example here. Imagine that a solar corporation's last dividend was 0.65. That is last dividend means D0. Solar's dividends are growing at a rate of 4% and the current price per share is $11.25. What's the market R implicit in Solar's rate? That is, if investors pay $11.25 for this stock, how much return as a percent they require from this stock? That's R equals D1 divided by P0. This is dividend yield plus G, growth rate of 4%. And since it's last period's dividend, 0.65, we need to adjust it to be D1, and we multiply it by 1.04 and divide by current price P0, add our capital gains yield and get 10%. So it means that if in these conditions investors pay $11.25 for this stock, they require 10% return from this stock. Stock price is present value of what they get, but sometimes companies not only pay dividends, they pay investors as stock repurchases. Using the dividend growth model, the price of a share will be higher if considering total payout rather than just dividends. That's straightforward because we calculated dividend and discount back to present value. If we have total payout, it will be higher than dividend. That is clear that present value will be higher. For example, we have an example. A firm forecasts income of $4 per share and will pay out 30% as dividends, 30% as a share repurchase, and will retain the rest. Only 40% will be retained. Its growth rate is 5% and the required return is 10%. What's the price of a share? Applying our dividend growth model, $4, since it's forecasted, it is next period, that's 4%, and dividend will be 30% of this. We multiply it by 0.3 and it becomes D1 divided by R minus G. We get $24. So dividend is 30% of earnings, $4. Total payout, investor will get 30% from dividends and 30% from share repurchase. So total amount the investor will get is 60% of income. $4 times 60% divided by R minus G, it becomes D1, expected cash flow. So it's $48. You see that price based on total payout is higher than price based on dividend payout. So far, we've evaluated stocks based on future cash flows, based on dividends. So what if a company doesn't pay dividends? We apply other approaches. One of these approaches is comparables. Comparables method is about calculating ratios based on peer companies in the same industry, in the same size, taking this ratio and apply to our company's earnings and others, get our price. Comparables are used to value companies based on primarily on multiples. Common multiples include price to earnings and enterprise value ratios. First, about price to earnings ratios. Price earnings ratio is calculated as the current stock price divided by annual earnings per share. We have PE ratio for industry. You can easily find this information from information providers. For industry, peer companies, we have PE ratio. We know our earnings per share, so we can then easily find price per share. Price per share equals to PE ratio times earnings per share. If we know PE ratio for our peer companies, then it means that it is expected that PE ratio for our company also will be same or near. So we can take industry PE ratio and we know our earnings per share. Multiplying these numbers, we get price for the share we want to invest. Suppose your company has EPS of $1.69. The industry average PE ratio is 26.94. What's the estimated price for your company? PE ratio equals price divided by EPS. We have PE ratio of 26.94 and EPS of 1.69. Multiplying these indicators, we get price per share, and we get $45.53. So we say that under these circumstances, if the industry keeps its PE ratio at this number and the EPS of this number, our stock price is $45.53. So investors will pay this amount for the company's stock. Some words about common stocks. Companies issue stocks as common stocks or preferred stocks. So they have some differences. First, some words about common stock. Common stocks have voting rights. So if you buy a common stock of a company, it means that you are shareholder of this company and you have voting right in the board to make vital decisions for a company. Voting rights may be cumulative or straight. Cumulative means, for example, if there are 5 members, board members will be elected. So if you have, based on your shares, if you have, for example, 1 voting right, you can vote all your rights to 1 member. But in a state, you need to vote for each member. So you cannot use voting right from this member to another member. Proxy voting, if you cannot come to board meetings, you may assign a proxy to vote on behalf of you. So stocks may be classified, for example, class A, B, C, and others. So it due to companies' financing decisions, also how to divide the ownership. For example, if a company doesn't want to give ownership public, so they may assign, for example, 50% of voting to one stock, class A stock. So who holds that stock, he or she has 50% of voting. Also, they have other rights, share proportionally in declared dividends. If pay out dividends as a common stockholder, you have a right to get dividends. Share proportionally in the remaining assets during liquidation if company goes bankrupt. So what portion is paid out to debt holders and other creditors. What remains after this, you have equal right as other owners as a percentage. What is your percentage? You get your amount from that liquidation. Preemptive right, if company issues new stocks, you have a right to buy that stocks. And some words about preferred stocks. Preferred stocks, as I said, differs from common stocks. They have some preferences, privileges. First one is about dividends. Stated dividends must be paid before dividends can be paid to common stockholders. They have some priority in dividend in dividends to common stockholders. Dividends are not a liability of the firm, and the preferred dividends can be deferred indefinitely. So due to the situation of company, dividends can be deferred or dividends can be paid in later times. Most preferred dividends are cumulative. Any missed preferred dividends have to be paid before common dividends can be paid. For example, for some periods, in the instruction of, let's say, that preferred stock, it says that a company will pay preferred stock dividends if net income is positive and the profit margin is higher than 10%. If that condition holds, preferred stockholders will get dividend holders. Otherwise, they will not get dividends in that year. But if next year that condition holds, they may get dividends are cumulative. They will get both years' dividends. Preferred stocks generally does not carry voting rights. If you have preferred stock in a company, that means that you have priority to common stocks holders in dividends, but you don't have voting rights as common stockholders. You have one priority, in the other side it trades off, you don't have voting right. This is all about stock valuation. Thank you for watching.